Joining us with more on this market reaction on the CNBC Newsline right now is Jim Paulsen, Luthold Group Chief Investment Strategist. Jim, are we about to see a change now that the Fed has announced it wants to scale back its stimulus starting next month in November meeting, for instance, and the fact that we're talking about higher interest rates and persistently higher inflation? Does that change the market view?
Well, I think the biggest thing going on, Sarah, for me at least, I think is a shift in economic momentum underneath all this. The COVID cases have clearly rolled over now, and with that has come a clear uptick in the Citigroup Economic Surprise Index, when the bond yields are certainly responding to stronger economic growth overall. Industrial commodity prices have gone to new highs. You look at leadership in this market, not only today, but the last week of this very volatile period, it's been led by the cyclical portions of the S&P 500 and by small cap, all economically sensitive. This is, to me, more about another reopening cycle, which we've been through in the past, which means you have underperformance by growth and tech and defensive, and you move back towards economically sensitive outperformance, more so than maybe a correction. It's just another leadership shift. And certainly the Fed could be playing some of a role in that, but I think they're just acknowledging the fact their hawkishness is acknowledging that economic momentum is picking back up again.
So what is the strategy? Go ahead, Wilfred.
Well, Jim, I was just going to say, to what extent does the rising you frame the rising yields there as almost a good thing, responding to reopening and a bounce in the economy? But clearly the market today, particularly as it relates to sectors like communication services and tech, is framing as a bad thing. Is it wrong to do that?
Yeah, I think it is, Wilf. Let's just look at the last week from the low. We came back today to challenge the low on the S&P 500 from a week ago. If you look back over that last week, yields have clearly gone up. That's basically been when they've really gone up. And if you look at that, there's 5 sectors that are in the green, and they're all cyclical sectors. And then the 5 sectors that aren't are defensive and tech. So it hasn't been that higher rates has killed off cyclicals and smalls and sensitivities. It's been that it's killed off growth and defensive. It's been a leadership shift, not necessarily a correction. And I do think it's a good sign. Look, the other interesting thing about this yield move is real yields are going up this time. That is, the 10-year yield has been climbing, but the 10-year break-even rate has not. So real yields are climbing in the United States, and that's typically a sign of better real growth.